Today I'm going to talk about what's going on with Luckin Coffee. What I did on Friday was I actually exercised 100 put options at a strike of 350. It is a very risky proposition because 100 put options, 10,000 shares. The stock were to open at some point down the road, I would have to buy whatever the stock opens at and agree to sell at 350. So potentially the best case scenario is the stock gets delisted and I basically buy them at zero and sell at 350. I did spend $8,900 on those options. I purchased them on April 6th and on the 7th the stock was halted. Nothing was going to be able to trade. Basically I had two options. One is to let my options expire worthless or exercise them and face potential loss. I had about a month to do some research in order to derive to my decision. I looked into a lot of different message boards. I watched a lot of videos on Luckin Coffee. I read the 89-page report published by Muddy Waters. I studied their business model. I read their financials, read every single piece of news article about them, both in Chinese and in English. Conclusion that I derived at, which is there is a high likelihood of them not being listed again. I'm using this video to record my rationale. For everyone that's watching, you can basically see how I came to my conclusion. And you may disagree, especially if you're holding stocks at this point. I welcome any counter argument that you may have. I think this is a very interesting case, generated a lot of attention. Everybody knows at this point that they self-admitted on April 2nd that they had committed fraud to the amount of somewhere around $310 million over the past 3 quarters. Basically, that was the last time they were audited right before they went public. Ever since they went public, they started fudging their numbers. According to the report published by Muddy Waters, the fraud started back in August of 2019. And I'm not going to go into the details of that report, but a lot of the materials that were presented, they were very detailed, very well presented, and they just seem to be factual information, very hard to argue against. The next point, I think their business model is broken. They try to expand very quickly, grow their customer base, and obviously that's just something that didn't work out for them because the customer base that they attract is very price sensitive and they don't necessarily need a coffee. They're just basically bargain seekers, and as soon as the discounts disappear, they stop coming. So it's not a very loyal customer base. Luckin Coffee, they opened their first store in January of 2018. They had some internal funding by the CEO. Planning phase started all the way back in 2016. They were planning on this coffee concept. After they opened their first store in 2018, they were able to secure their round A funding from Joy Capital, Legend Capital, the GIC, and then Centurium Capital. When you look at kind of behind the curtain, everybody that's involved in these 4 firms are part of the chairman Lu Zhengyao's circle. They were all somehow connected previously. It is a very closed circle funding. In June of 2018, the CEO Tian Zhengya, she was able to get the funding, and then in December she received the second round of funding for the same amount of money, $200 million. By June of 2018, they have about 800 stores, 800 to 1,000, because by the end of 2018, that's when they kind of reach their second milestone when they get their round B funding of $200 million by pretty much the same investors. But by that time, they already have 2,000 stores. They set a goal to open 2,500 more stores by the end of 2019. So this was all very well planned since the beginning. They knew what they were going to do. They knew what their strategy was, and basically they need to grow very quickly in order to attract the attention of larger firms, more reputable firms, because their ultimate goal was to IPO in the United States. They were able to get their round C funding from a very, very reputable firm, BlackRock, in April of 2019. The amount was actually less than the previous 2 rounds, but it doesn't really matter. It's all about gaining the confidence from someone who understands the coffee industry, because BlackRock also invests in Starbucks, and some reputable firm from the US, and that would basically just open up the door for them to be introduced to the US and eventually attract more investors and investment banks and allow them to IPO a month later. So in May of 2019, they IPO'd on the NASDAQ, received $651 million. They were expecting to sell between 15 to 17, and then they sold on the higher end, they sold at 17. They grew very quickly from the first store to basically going IPO with a matter of 18 months. So just 8 months later, they did a secondary offering, another $418 million, sold at $42 a share. So this is the recent timeline for the ascension of Luckin Coffee, basically becoming the unicorn of the coffee industry, achieving something that no one's ever done before. However, now you're looking at how closely those financial events are happening right next to one another. You start to wonder, why they're burning through cash so fast. Well, by looking at their financials, it seems like it's just because they're growing, they're opening a lot of units, but it doesn't explain the reason why they have to commit fraud. Well, some might believe it's out of greed. Upon a closer look at their numbers, I believe it's out of necessity. So in order to figure out the reason behind their scandal, we should be taking a closer look at their actual sales and the sales numbers that they presented. And that way we'll figure out exactly how fast they're burning through cash, and that will provide the reason for their secondary offering and kind of explains why they almost had to commit this fraud in order to survive. So the Muddy Water report said they inflated their sales and their expenses. So I actually did some math. I looked into their SEC filings, and also I made some assumptions on my own. And this is how I derived their sales numbers. So if you look at their store number in 2018, they ended the year with 2,000 stores. So that means for the entire year, they averaged about 1,000 stores. And we know that by the end of 2019, they have 4,500 stores. So I'm assuming they average about 3,250 for the year. So we know this number is somewhat reliable. And so what I did was I just used their 2018 number and multiplied by 3.25 to get their sales estimate for 2019. And I think this number can be generous because we are basically assuming that by opening more stores, they're not cannibalizing any of their existing stores, which is usually not the case because, what happens is when you open more stores, your sales per store usually goes down, especially when you expand in such a short period of time. So I took their actual, and their cost of goods sold was actually higher because, as mentioned in the report, they actually inflated their sales price. By making that adjustment, we know cost of goods sold is actually 7% higher than what they reported. That gives you a gross margin for the whole year, $163 million. Their rent would be the same. I actually reduced their marketing expenses because in the report it says they probably inflated their marketing expenses in order to funnel that back into their sales figures. So what I did was I looked at pre-IPO marketing expense and I just extrapolated to a whole year. This is the marketing expense that I calculated, and this is the one based on what was in their financials. SG&A stays the same. There are other expenses which includes depreciation and expenses related to opening new stores. So all the other expenses stay the same. And look at the net income. This will give us a cash flow of negative $482 million. So altogether, they inflated their sales numbers by $310 million, and they also underreported their expenses by about $100 million. Okay, so now with this information, let's go to the next slide. What's going on with their operation? Why are they cooking the books and try to inflate their sales? Well, because if they don't receive the money in January by pumping their books, if they don't create a fast growth story which will allow them to receive additional money in January, their cash flow will become a problem. So let's look at this cash flow chart. So based on the end of 2018, their balance sheet says they had $228 million in cash. they received this much for their IPO. This is how much they spent for the first 9 months of the year for 2019. Based on my calculation, this is what they reported. About the same. This is all the information that we know right now. So after that, what I did was I estimated that their cash outflow for the fourth quarter to be around $130 million. This is the difference from cooking their books. So we need to subtract this out from their cash holdings. Once you add everything together, and I am assuming that for the first quarter of this year, their cash outflow is going to be around $150 million. This is a pure estimation. It's just based on now that they have more stores. Those sales has been pretty abysmal because of COVID-19 that's currently going on. I would assume that their sales number is only a fraction of what it was. Based on these numbers, this is the estimated balance in their cash account today, or by the end of March 31st. They have $1 billion, right? It looks like it's a lot of money. But let's imagine, what if they didn't receive their secondary offer back in January? So this would be the cash on hand that they would have today. Based on the rate of their cash burn, if they were not able to receive any of the funding, then their cash on hand would only last them for a little over 1 quarter. So that means they will run out of cash by July. But because of the secondary offer, now they have 8 quarters of cash burn, basically. But in order to achieve this amount, again, what they did was the secondary offering, they received a total of $865 million. So their stock offering were sold at $42, and then they also offered the rest in a convertible bond, which is highly correlated to their stock price. The market usually perceives issuing convertible bonds as a form of stock, hoping that at one point the stock price will go over the conversion rate. The conversion price, basically the investors can have upside because the convertible bonds were actually issued with very low interest rate. It was 0.75% coupon for the whole year. Now, let's look at their stock chart. This is their stock performance since their IPO. For the first 5 months, the stock had stayed very consistent. There wasn't a lot of up and down going on right here. As soon as we go into November, after the third quarter numbers came out, and you start to see this tick up. And this is what they planned for. It went all the way up in the mid 40s by January. And this is when they did their secondary offering. Let's just assume if they never pumped their books. The best case scenario is that they did a secondary offering at $20, and maybe they were able to gain some traction at this amount, but I doubt it because that would raise a lot of red flags. Investors will be looking at the company and question, you're not growing, why do you need additional cash? They basically have to put on this window dressing and pretend that they are a fast growing company that's burning through a lot of cash, which makes the story reasonable. So let's just assume that they were able to receive some kind of secondary funding at 20. What they end up receiving is actually a lot less than what they have right now. So instead of having $1 billion in their cash account, they would probably just end up having somewhere around this number, $340 million. In reality, if their stock stayed at 20, they might not even be able to issue any secondary offering. But even at this number, it's only going to last them for about 6 months.